In this video, we'll look at the currency profile for the euro. Now, the euro is the single currency used throughout the European Union. And even though the European Union has a monetary union, which means one central bank and one currency, they don't have a fiscal union. Now, this makes monetary policy especially difficult given the risk of things like spread fragmentation among bonds from different member states. We'll touch on that in a second. The benefit of the union means open borders among its members, which is usually the biggest contribution to GDP, but it also poses risks. Being so dependent on each other for trade and dependent on the same currency and short-term rates, it's challenging to find a sweet spot that works for every member state in terms of economy and monetary policy. Now, looking at the stats, we can see 16% of the world's global forex transactions involves the euro, which makes it the second most liquid currency after the US dollar. In terms of trade dependency, it's worth focusing our attention where the bulk of GDP comes from, which is France and Germany. The reason for this is quickly explained with this handy illustration from Eurostats, which shows that Germany and France alone accounts for close to half of total Eurozone GDP. Now, for Germany, the United States is the biggest trade partner, which accounts for 8.7% of exports. Germany's single biggest export product is motor cars at 9.2%. For France, the biggest single export destination is Germany at 13%, with the single biggest exports being packaged medicaments at 5.9%. Now, looking at the trade dependency in a bit more detail using data from the OEC, we can see that for Germany, there is big trade ties with countries like China and the US. But of course, when we combine all the fellow Eurozone countries where Germany has free trade, the dependency is close to 60% with the EU and close to 70% when we include the rest of Europe as well. For France, it's the same story with big trade occurring with China and the US, but the bulk of trade is focused from within the Union, which does leave both countries exposed to Euro area-wide slowdowns, as it will affect their biggest aggregate trade destination. Now, in terms of risk profile, the euro doesn't really have any significant correlation to risk sentiment. If we take a look at the aggregate data, we can see there is a positive correlation to equities for the most part, but again, no meaningful correlation to risk. There have been periods, though, where negative interest rates in the Eurozone have seen market participants use the euro as a funding currency against higher yielding emerging market currencies, in some cases trading like a safe haven, but the currency isn't considered as a safe haven in the same sense that we would consider the yen, the Swiss franc, or the US dollar. Now, the other factor and important driver to consider for the euro is spread fragmentation. So what exactly do we mean by spread fragmentation? Now, a lot of this will make a lot more sense if you've already completed our dedicated module on fixed income, where we discuss the basics of bonds. But looking at it in a nutshell, the Eurozone is a monetary union, meaning the ECB controls monetary policy for the whole bloc. But they don't have a fiscal union, meaning each country runs its own fiscal policy, which have in the past created massive debt risks considering things like the sovereign debt crisis back in 2011 and 2012. Now, the way that market participants usually look at spread fragmentation risks in the Eurozone is by looking at the spread between Italian bond yields, called BTPs, and German Bund yields. The spread between these is referred to as the BTB Bund spread, which is basically the Italian 10-year bond yield minus the 10-year German Bund yield. So why is this spread between these two so important for the euro? Well, there is a very big difference between an economy like Germany and an economy like Italy. Would you rather invest your money in a country like Germany, which has very low risk of defaulting on their debt and is considered a safer option? Or would you rather invest in a country like Italy, where you would have a higher default risk and have a less sound financial fiscal stance? Well, the answer isn't as simple as saying Germany, because there is the question of yield. If you have been offered the same amount of yield to invest in Germany versus Italy, you will of course have chosen the safer option, which is Germany. Now, something that might change your mind to invest in Italy over Germany is if Italy offers you a higher yield, a higher return on your investment. A country that has a higher default risk and is less financially sound will oftentimes need to offer higher yields to make their bonds attractive enough for investors. Now, this is why your emerging market currency bond yields often have to offer higher yields compared to that of developed nations because of the higher political and socio-economic risks. Basically, investors will require to be compensated with a higher yield for taking on more risk. So the reason why the BTB Bund spread is such a watched spread among market participants is because you are comparing the risk-free rate from the German Bund yield with that of the higher risk Italian BTP yield. Now, when the spread rises or widens, it's usually a bad sign, as it means that there is higher spread fragmentation risk, and when the spread falls or narrows drastically, it's usually a good sign because it shows there's lower spread fragmentation risks. Now, keep in mind though that the spread has two cogs, both the Bund yield and the BTP yield. That means that the spread can narrow or widen if just one of the yields moves while the other one stays flat. So figuring out the reason for sudden falls or rips are very important to assess the potential impact it will have on the markets. For example, the spread can fall rapidly due to a few different reasons. It could be monetary policy, when the ECB is expected to hike or cut rates. It could be geopolitical uncertainty forcing the spread higher, or it might be domestic policy uncertainty. For example, in 2018, where we had a lot of political instability in Italy. As a result, the spread rose due to what markets call redenomination risks, which is just a very fancy market way of referring to the risk that a country could leave the Eurozone, like we saw with the UK and Brexit. Now, in 2018, there were growing fiscal risks in Italy, with the EU rejecting the Italian government's budget proposal, and we also had the European Union opening up an excess deficit procedure against Italy. Now, this saw a big rise in the spread, as we can see here on the chart. And it wasn't due to higher inflation or tighter monetary policy, but mainly due to political uncertainty with growing risks of an Italian exit of the euro area. Or what if we consider the massive blow up in the spread during the European debt crisis back in 2011 and 2012? It wasn't monetary policy that was to blame for this or political risks in Italy, but rather the sovereign debt crisis that risked the total collapse of the union. Now, what is so bad about Italian yields moving so much higher than German yields, you may ask? Well, the effect of a rapid rise in the spread isn't felt immediately, and the transition effects can take some time, but the impact is clear. As yields rise, let's say perhaps in anticipation of higher inflation and tighter monetary policy, it will force yields higher across the board, which will force the BTP yields higher to try and stay competitive with the risk-free rate from Germany. The problem, of course, is that the higher that the BTP yield goes, the bigger problem it becomes for the Italian government, as it means that their borrowing costs will rise alongside the rising yields on any new debt issuance. Now, like we learned in our module about monetary policy, a country's 10-year yield is used as a benchmark for other borrowing costs. So as they rise, it'll hit consumers and businesses from a borrowing cost point of view, but it will also hit the government. Remember, when the government issues bonds for the first time, they issue them in the primary market. Once that bond has been issued, it moves into the secondary market where it can be traded. This is important because as the current BTP yields rise, it means that any newly issued debt will have to be issued at those higher levels, which means higher borrowing costs for the government. So when we refer to spread fragmentation, we are referring to the rapid widening of the spread between German bunds and something like BTP yields. The reason why the spread is important from a currency perspective can be clearly seen by looking at this chart where we have the BTP Bund spread in white versus the euro in blue. There is a strong inverse correlation between the spread and the euro. Now, like most correlations, it's not perfect, of course, and there will be times when the spread will fall or rise without it having any meaningful impact on the euro. So as always, the context and the reason for the moves are more important than the moves themselves. Now, in terms of correlations, apart from the BTP Bund spread, the other correlation to pay attention to is that of the dollar index, or the DXY. Now, the dollar index is a weighted index that measures the value of the dollar versus 6 other currencies, namely the euro, Swiss franc, yen, Canadian dollar, sterling, and Swedish krona. Now, the weighting of the index matters. We can see on this chart that the euro has by far the biggest weighting at 57.6%. So that means that any sudden moves in the euro-dollar currency pair can drastically impact the DXY. And if the DXY is driven by stronger moves in, let's say, any of the other 5 currencies, it can also impact the euro-dollar. If we take a look at this relationship by just inverting the euro-dollar, we can see that strong relationship. So this means when trading either the euro-dollar or the dollar index, it's important to keep an eye on the other chart. Oftentimes there might be important inflection points between these two charts that we can use to our advantage. For example, if the dollar index is reaching key levels of technical confluence, maybe driven by the influence of other currencies in the index, it could impact the euro-dollar currency pair if the dollar index bounces from key support and key resistance. Again, given the correlation, it's likely that the two will reach the opposite levels of each other. For example, when the dollar index reaches support, we would expect euro-dollar to be reaching resistance, because the two charts are very similar, as we can see from this chart, which makes it another important correlation to keep in mind for the euro.